Good afternoon to all. Welcome to our second episode of Friends with Benefits, wherein we reach out to professors to hold a discussion to know their opinions on the latest topics, issues, and trends relevant to the current financial market. Let me introduce to you all the members present in today's podcast. Professor Florescu, Director of Hanlon Financial Systems Lab, and Professor Majeed Simaan, Assistant Professor of School of Business at Stevens. He did his PhD in finance, and his research revolves around risk management.
So can you basically, I'm doing, my specialty is stochastic processes, which is pretty boring too. I wrote 3 books on that, but very boring, very hard, very mathematical. But I use the stochastic processes and stochastic calculus for derivative pricing. So, I mean, the listeners of this podcast, I'm assuming they don't really know what is a derivative.
I have a student, every time I mention stochastic calculus, he said it comes from here, it gets from the other way immediately.
Well, I mean, yeah.
So you just feel like somebody slapped him in the face anytime he hears stochastic calculus. Yeah.
So it's pretty hard area, and of course not everybody is suited for it, but there is a definite need for us to value these things called derivatives and so on. So far the discussion was centered around, can we invest into the market, stocks, ETFs, even ETFs are some sort of derivatives, right? But what exactly are derivatives, if you could explain very little, and why should we care about this?
Yeah. So, but you mentioned stochastic process. Should I talk about it?
No.
Okay.
I don't want to be slapped. No.
So derivative, as I tell my students, if you speak, translated from literal English, right? It's like derivative. And usually ask the students. Actually, I did teach high school kids in the summer for a special program. And I talk like, do you know what derivatives is? And, some actually students were already, some were actually already know about it. But most of the time I get, not most of the time, there's a significant proportion of time people think about derivatives comes from calculus, right? So the first derivative. That's not really the case, but in our case, it's actually thinking about something being derived, right? And so derivatives are actually, you can think about it as what we call contracts, or we can think about it as contingent claims. Contingent claims mean, think about insurance. Insurance is a sort of derivative in the sense because the value of that policy is derived about if something happens in the future. Now, you can think about this, you can actually create these contingencies or these claims on individual stocks. So one way you can think about it is, you can think about it as buying insurance in your portfolio, right? So, for instance, I'm worried about inflation is going to persist. I think tech companies going to be hurt the most. And let's say my pension is basically allocated to growth stocks, right? So thinking about, I'm trying to hedge that, or when I think about if that goes down, I have something to, compensate me for the downside. So one way you can actually buy insurance on the downside. So you can do that through derivatives. One way to do it is buying a put option, right? Now, put options, actually, its value going to be derived if the underlying, is usually we think about it as the value of that derivative is derived by what we call the underlying. So think about my case is, if I'm worried about the stock market's going to tank over the next 2 months, right? So I could buy a put option on the SPY, and that's actually going to increase in value as soon as the stock market. So idea we can think about this is from the concept of hedging. Now, this is also a very dangerous game because what happens is in options, you actually could lose 100%. So if we survive over the next 2 months, right, maybe my portfolio is going to drop, well diversified, maybe drops 10, 20%. But if I take all my capital investment and put it on these derivatives, the dangerous part of derivatives is that you could actually lose 100%. So your downside is limited, but also limited that you actually lose all that money. So that makes it very dangerous. And the fact is, also insurance is expensive, right? So insurance is expensive, actually could be paying a lot of premiums, right, for that hedging aspect, versus you could have invested that and maximize your future wealth. And there was a research by AQR, I think it was the Journal of Investing or Journal of Portfolio Management, one of the practitioner journals, and they were actually showed that based on the data they got, overall, actually investors tend to spend too much money on premium in order to speculate or hedge, but they could have done better by investing that money passively. Again, when you want to think about hedging or risk management, it's not hedging or managing things after the fact. It's all the idea is what's my projection over the next 2 months, and how can I actually make a decision that could be correct? And that requires, more. You can think about it, we could use stochastic processes or fancy machine learning algorithms, but also requires a lot of qualitative information, because we could see that in 2020, a lot of the quant funds actually underperformed qualitative funds, because we're dealing with a period we have no idea. We had non-conventional monetary policy. The Fed actually, for the first time, purchased corporate bonds. That never happened before. And there's so much uncertainty, we actually never saw it before. And that actually creates a problem. How can you actually take that? How a model can take that? And we could see that in that year specifically, the quant funds didn't do better than the qualitative funds. And again, how can you actually digest that information, right?
Well, so I would like to answer my own question. So basically, I want to start from a much simpler perspective than what you have. And for example, we all know there's a Ukrainian war going on, right? Mm-hmm. And we all know that Ukraine is one of the largest producers of grain, right? Wheat and cereal products. Mm-hmm. And a lot of percentage of the world depends on that, right?
And which links back to inflation and food prices.
Right. Yeah. But fundamentally, if I'm a farmer in Ukraine right now, I'm worried about the future, right? I'm worried about, so right now I have my grain that is here. And I know that I want to be able to sell this grain, but not now because it's in the field. I haven't even cropped it yet. I want to sell this thing later on. I want to deliver it in the future. So what does the Ukrainian guy do? He doesn't know about futures, doesn't know about any financial derivatives. So what he does is he goes to the government and says, hey, government of Ukraine or of Russia, how the case may be, would you like to buy my grain for, $20 a bushel or whatever the quantity? I have no idea how much the quantity is. And then the government of Ukraine or Russia is going to say, I'm not going to do that. There is risk involving transportation and all that. And, I'm going to offer you $5. And what is the farmer going to do? Take it. There's nothing he can do about it, right? In the US, that doesn't happen because here you have free market, which means that the farmer can say to the government, certain that I'm not going to say certain things, and then he's going to go to the exchange and say, okay, here, this is my grain. Who can offer, if I deliver it to this particular place, which is a big question, but if I deliver to this particular place in this particular day of this particular year, how much are you guys willing to pay for that now? Okay, that's called the future. So that exists in the financial markets, and that's what makes makes us able to cope with fluctuations of the. So when they tell you, the prices of look at the price of the gas now. The price of the gas is much, much lower here than it's anywhere else in the world. Why is that? Well, because when they raise the prices back, it's because none of the politicians understand finance. So they just said, okay, times are bad, we need to raise the price. But no, prices are established. They've been done for a while, right? So what happened is people just raise the prices to profit in immediate term. I'm taking advantage. That's free market. And that's what you need to cope with. But so free market is good because it's full of, planning and so on, but it also can be bad because and again, I'm talking from the perspective of a mathematician here. I don't really, you're the economist and the finance guy, but I'm just speaking about what I know that, So anyway, derivatives.
So definitely, speaking of derivatives, one aspect is as the farmer's example, and then derivatives existed like forever, right? So you can trace it like.
Well, wait a minute. In the U.S.
Well, I'm saying internationally, people always traded, right?
Hello, not in Romania. In Palestine, right? You're from Palestine.
I'm sure people advance, and even people did exist trading, and I think there was basically going back to the I think it was before century. People had some sort of way to hedge, and I think people did trade. So there's actually
okay. So hold on, let me clarify. So what is the future? Basically, what's the big deal about it? Yes, you're right. So we make a contract between you and I. I'm the farmer. I'm going to sell you a ton of wheat. And then you're going to say, okay, I'm going to deliver it to you in Bucharest because it's a part of European Union. It's not part of the, war ravaged Ukraine. My business to transport the grain over there. And you're going to pay me in next January, you're going to pay me $100,000 for this or whatever, $100. I don't know. So now what's the big deal is we make the contract. This is happening since immemorial time. You're absolutely right about that. What the future makes capable is the following. You can take that contract and sell it to Sakshi and say, Sakshi, listen, I don't have the patience. I really need $90 now. So I'm going to sell you this contract that you're going to receive $100 in January, and you're going to pay me $95 for it now in September. That's what the future contract does. So it's basically standardized this capability of, and me, I don't care, the producer. I know that I'm going to deliver my thing, and I'm going to get my money, $100. I don't really care who's, you know, and this can happen at the other side too. If I cannot manage to, you know, to deliver the grain, I can talk to, you know, my, you know, Marvin that I talked about, who's another producer, who says, okay, listen, I can't produce the 1 ton, okay, but you can I sell you this? And then you can say, okay, sure, I'll do it if it's advantageous for me. I'm not going to do it if I can sell it right now on the spot, you know, for cheaper, for more expensive. So
speaking of futures, basically, I'm sure some of our audience, they remember what happened in 2020 when the oil prices futures contracts were negative. So what actually happened is, as Professor Florescu basically mentioned, a lot of people will be trading commodities to secure the prices. So we always think about a business, we have the input and the output, right? The input is basically you want to put an upper bound on how much it's going to cost me to keep doing my business. Because any business, you can think about it as there's the ends and the outs, right? If you have a lemonade stand, you need lemons, and then you can actually see what's going to be the price of a cup of lemonade, right? Or maybe the plastic, I mean, that's going to be the cost and so on. So what you want to do is you want to cap your inputs, and then you want to basically put a limit, lower bound on the output, right?
So the difference would be the profit. So you have a guaranteed profit.
So a lot of business actually engage that. So you basically meet sometimes like people who trade coffee. Now, the question is also that creates a lot of speculation. You know, banks are big players in what? There's 2 markets at banks. And banks, as we always say, originally they're a very boring business because they follow the 363 business model. So their input is actually costing 3%. Their output is so they take deposits, give the deposits, give Florescu 3%. And then they give the money to entrepreneurs, let's say about the 6%. Now, what's the other 3? By 3 p.m., they will be at the golf course, right? So that's basically a joke. 363. So, but now actually they're more complicated.
That's Romania, by the way. That's the European Union. Everybody's leaving their job at 3 p.m. to go play golf.
So the idea was the business model, they were not as complicated. But again, if you look at the banks are big active in interest rates because again, they're dealing with a 3%, 6% and how basic interest rates are moving. So, and he wants his money immediate. The entrepreneurs want their money for 30 years. So that actually creates a maturity mismatch. So it's a complicated, so they would be very active. Now, they would be, on one hand, managing this risk. There, of course, you know, a lot of it is dominated by smart people, forward-looking, that actually know how to digest information and make decisions. There's a lot of speculation. Like, for example, somebody might be trading coffee or commodities just without actually trading. And that's what happened in COVID 2020 when the oil prices went down because nobody wanted to actually hold these battles, because what actually happens as soon as comes to the maturity expiration, it means you're actually going to buy these barrels or deliver them, right? And there was a problem with storage, right? Because there was a lockdown, nobody's actually buying. So that's why you would get money in order to get these barrels of oil, but also like we're stuck in our apartment, so we're going to put these barrels of oil, you know, so that's what.
Yeah, so let me actually expand on that, because the US market, the exchanges in the US of these commodities become really sophisticated. They've been trading commodities since the 50s, right? And the market is really sophisticated now. And particularly this example, there are futures on oil, on actual oil. They call it physical delivery. Basically, once you own a contract, between 2 parties, this party has to deliver the oil once the contract expires, and that party has to buy the oil. There's no way around it. But they also have contracts on, they call it synthetic contracts, meaning that there is no physical delivery. Basically, what happens is you can deliver cash. You're going to deliver cash.
Financially settled.
Yeah, it's financially settled. So you don't deliver the oil, you just pay the money, that the oil is costing at that particular time. So normally there is no equilibrium between. So let's say the contract expires in January. We're now in October. So I still have 2 months. So at this point, I can technically sell as much oil as I want in terms of this physical delivery contract. So I can sell, maybe I'm going to deliver 1,000 barrels, right? But I can sell contracts valuing,
As long as-
100,000 barrels.
As long
right?
as you can keep up with the margin.
Right. So as long as I can keep up with the margin, that's correct. So basically, I mean, we're not going to talk about margin, but it's basically a minimum amount that you need to have.
Collateral, you can think about.
Collateral, yes.
Yeah.
So now what happens is, if the price right now of these futures is really high, well, I'm going to sell them, because right now the price of so this happened during COVID, the price of the gasoline or the oil kind of exploded. So now what happens is, I'm going to lock that price in. So I'm going to say, okay, I'm going to deliver this oil in January, but for the price today, because I don't know what's going to happen to the price in January. And my anticipation is this war is going to be short, this is not going to last very long, and the price is going to go down. So everybody started selling contracts, right? So the panicked, people on the other end, they started to buy them, because you don't know how much so then you have a situation where the contracts you sold, you took a lot of profits from this, but now you can't deliver because you don't have enough oil. So now what happens is, you want to get rid of the freaking contract because you don't have the oil to deliver it. So I'm going to sell it at a discount. Like, okay, I paid, I sold this for like 70, so keep doing, and then oil price becomes negative, and that's crazy. The future prices become negative because people want to get rid of it.
Yeah. So there's some other costs when thinking about futures and the underlying, they move together, but there's also, when thinking about it, as the cost of carry, right? Which basically includes storage. For example, I can buy gold. So one of my friends and co-authors, actually, he buys actual gold, and I was asking, why don't you buy futures? He says, like, in case there's a zombie apocalypse or something, he wants to have real gold, like going back, because like the future is would be financially settled. So but yeah, and the idea is that then, now that I have gold in my apartment, right, I need to think about storage and other stuff. So when you buy futures, you don't have to worry about the storage and other stuff. So that takes into account. You think about that actually should be priced in the contract itself. So that's what we call in pricing derivatives the cost of carry. Yeah.
So let me ask you. So we're kind of getting close to the end here.
Really, I thought we just started.
Actually, it was pretty enjoyable, the discussion, to be honest. I ran out of coffee.
Well, the other guys are suffering though. Yeah.
But maybe just ask one kind of general question.
Yes.
But maybe you can make it specific. So
Yeah.
But I mean, it's no going around, because it's a very, very open-ended kind of question. So the question is, we're learning a lot of stuff.
Yes.
All good.
So we're learning a lot of stuff in our courses, right? And at the same time, there's a transformation to the financial market. We're seeing that there's a lot more digital payments, digital currency. There's like a lot of, and yet we're learning about optimization. We're learning about if I decide to buy this 100 shares, how some 100 assets, how much should I buy in this asset, So you have to solve an optimization problem. So the question is this still relevant in today's world? The learning of the traditional fundamental kind of things that we do in our courses, in the light of today, we have machines, we have robo-advisors, we have...
I think our field is always evolving, right? So I think there's no right thing to learn stuff. I think the best way to learn stuff is build something, right? So I think if you want to, for example, learn about a coding language, you don't want to just go and memorize stuff. You want to see what kind of problems people are looking at. So a good example is look at Kaggle competitions. They basically will show you different problems people are looking into, and then would be a good challenge, because now you actually try to put your skills, or basically more forge your skills or stuff you learn, into something more applied. So I always recommend whatever you learn at school, right? You're getting some basic, right? And I think the whole idea is you always want to keep evolving and advancing, and this is actually what makes us human. We're very resilient, right? But also we're very adaptive, right? The fact that, think about Darwin evolution, that's our nature, right? There's so much limit how much we actually can do, but I think it's just what really matters is the is the thought that he actually can build that to the students to question things, be flexible, right? Be able to adapt. I think that's a very important skill. You can think about it as, when you think about, there's always discussion about behavioral economics versus actual, new classical economics. You think about what kind of agent you're talking about. Like there's the Richard Taylor, for example, he got the Nobel Prize in behavioral economics. And economists keep saying, people are agents, rational, optimizing. And they say, what kind of agents you're talking about? When I go with my friends, they're all economists. We don't know how to split the bet, right? So basically indicates what kind of rationality you're talking about. This is really descriptive of that. But I think in order to get to the behavioral aspect, you always want to understand the physics without frictions, right? So I think that's always important to have a fundamental aspect of things, how things work. And after you know that, you can think about by introducing frictions, how things are changing, right? So again, speaking about centralized finance versus decentralized finance, I think it's important to understand how centralized finance work before we actually go to decentralized finance, right? So for example, so I think there's concepts, and I think if you have a good infrastructure, you should be able to adapt that. But definitely, the business, our businesses are evolving all the time, right? Academic environment is evolving over time, technology is evolving, and I think it's just a matter to keep an eye open and for example, my class tried to keep it as applied as possible. For example, in my class, I talk about a case study, LTCM, which is a classic case study, but then you can see about it says also a classic example of operational risk. But then last year, Robinhood had a big margin call because of that GameStop AMC trading, and they actually got a margin call of $3 billion. And basically that was a sort of operational risk. So we tried to talk about, that stuff and how that actually links, because you see sometimes actually history does repeat itself, right?
LSTM, can you tell them?
Long-term capital management. So usually,
it was a very big hedge fund created in the 1990s by the people who are very famous in finance, of course, because the Black Scholes,
so I think it was Merton Scholes, and also was a legendary bond. I think he passed away by the. I think he was not, because he didn't share the Nobel Prize.
No, but this is LSTM is before the Nobel Prize.
But yeah, I think so. That's why he didn't get the Nobel Prize, because I think he passed away before that.
Right, but the LSTM was.
Well, I hope not, but we don't take that as a.
So this is pretty famous because it was basically a fund driven by quantitative guys.
Yeah.
And they were making a lot of money, and there was like a lot of people put into it, and then all of a sudden they had an issue, right? And it was driven by
uncertainty in the global markets. But their idea was, again, speaking about going back full circle, how people actually make money. So LTCM were able to get money, first of all, because they had like very reputable people, right?
No, so, they also have applied the principle. So they were doing basically one of the reasons why they fell down is the Black Friday. The Black Friday was the consequence of them, the LSTM, if I remember correctly. I might not. But what they were doing is basically kind of using options. They were kind of innovative in this area. And the problem is when you're trading options, and I think that's fundamental to your course, which is why you're mentioning it in your course, is that when you're trading options is called kind of leveraged. So like Majeed said, when you're talking about futures, right, you're talking about things that don't exist. When you're trading, a stock, that's basically a piece of the company.
Yeah.
But a derivative is a promise to buy a piece of the company. So you're trading promises. You're not trading physical stuff. So that comes with a bigger risk.
Yeah.
Particularly, so when you actually calculate this risk, it needs to be operationalized. In other words, calculated differently, and that is what they failed to do. They failed to take into account that there were a lot of their strategy becoming so popular, making so much money. Of course, it's going to be copied by a lot of people.
Yeah.
And when you have a lot of people that are doing the same thing at the same time, that drives the price and drives the price a lot more.
So a good example what actually happened is, another way you can think about it is use derivatives to leverage your position. But originally what they did is, speaking of, you had two securities, let's call it two bonds, right? One is let's say, a developed country bond, such as Germany. The other one was at that point was, let's say, a Spanish bond. And my understanding that at that point, Spain was not part of the EU. And you say eventually they're going to be under the same umbrella, so they should be both trustworthy in terms of a debt debt agreement. So eventually they should converge, right? So what they actually did, they were shorting the overpriced and longing the underpriced, right? And by doing so, they said that is actually the gap is going to shrink and they will be able to make money. Now, what happened is they did very well, but also, again, that's what makes markets very interesting. Markets are dynamic. So he sees me doing this, right? He's going to do the same thing. So what's happening is we start squeezing the profit. So I used to make 5%. Now I'm only making 2%. Now, how I can keep it up with a large percentage, what I do is I take leverage. So now I take 10 times the risk. So now I'm actually making 20%. And that's what it is for 2 years until, I think somebody said that, I think it was Mike Tyson, everybody has a plan until you get punched in the mouth or something. So
the plan changed.
and what happened is, and this is also what makes things very hard, is like trying to anticipate this black swan event or this like outlier. And what happened at that point, Russia actually defaulted on their government bonds, right? And that was like something not really thought about. So that created a panic. So what actually happened is instead of shrinking, people started like selling here and buying more. So that actually went against it. That shouldn't be a problem if you trade your own money. But if I'm trading my uncle's money, my uncle's gonna call me, like give me my money back. So that's what we call leverage, right? You borrow money to make more profits, but it goes well in one side, but it goes much worse in the downside. So they got a large margin call, right? And eventually they ended up being bailed out, or got an assisted bailout by the central bank because they were so systemic in the sense of like if they fail, we don't understand the repercussions. And again, when you think about how this links to the banking system, and the banking system is the infrastructure that connects capital, so this actually would be a major problem in terms of that. So the uncertainty was too high, and eventually, so that's the classic.
Yeah, I mean,
yeah.
this is happening everywhere. So this happened like in the real estate market, right? The biggest, like in 2009, and it happened in Romania way before that. So basically, in Romania in the 2000s, that's my country. There was a big real estate boom. Everybody was building. Everybody knew we were going to European Union in 2005. So everybody knew the value of the real estate. You would see a house in Romania, it was sold for $20,000 in Bucharest, and the same house in any other European capital, it was over 100,000, so 5 times more. So the idea was, okay, can we build houses we're going to finish when we get to the European Union, and I'm going to sell them with the prices of the European Union. And people would buy land, they started develop, and then they started to sell houses, and this would be so profitable that they would say, okay, I'm going to leverage this in the sense that I'm going to go to the bank and I'm going to tell them, look, you see this thing? I value this, so I paid for this $2 million. But when I sell it, it's going to be $10 million. That's $8 million extra. Can you give me like a loan for $6 million so I can use it to buy another one? So they would take the $6 million, buy 3 more properties, each for $2 million, and then they would go back to the same bank and say, hey, listen, now I got, $32 million worth of profit. Can I get some $9 million in addition to what? So kind of like a leverage, like a house of cards, right? Then what happened?
Yeah.
Then what happened? This went really well for like a few years until we get the European Union. Yeah, and then they got punched in the face because at that point, what happened is the price of the house that they were marketing to sell for like $100,000, all of a sudden it would sell for like $90,000, and that is not a big deal, right? You'd think about it. Oh, wait a minute, what's a big deal? I bought went from 20,000 to 200. Now we go from 20,000 to 90,000. Well, it is a big deal because you took all that profit that you were going to make and then you leverage. So the $10,000 drop isn't actually $10,000 because it's $10,000 from this investment. It's also $10,000 from this other investment, from this other investment. So it's kind of like a house of cards. If you drop a card from here, it's not a big deal. But if you drop a card from here, the whole thing tumbles. So that's basically what happens with all of this leverage stuff.
Yeah. And that's actually, again, a good example. That's what the Wall Street bets actually figured out with the short squeeze. They understood that when you short a stock, you also actually use leverage. And eventually, that's actually also created the whole saga or the mania that all the retail investors start jumping on stocks that actually fundamentally shouldn't be not good companies. But what they try to leverage is to understand how short squeeze works. And the short squeeze actually was because of leverage, right? Because we actually short a stock. You're not, it's a complicated process, but eventually it's kind of similar because you're borrowing money and then you have a collateral, right? But then if the bet goes against what you actually did, and you keep losing money, right? So you eventually end up like, oh, I can't keep doing this anymore. And that's actually created some mechanism that, you give them kudos to that. They actually understood how that works.
This happens everywhere.
But the problem again is what happened, is that actually retail investors at that point made money. But then when I start talking to people after like a month of that short squeeze or two, people still like pouring money into that. So I think those are the people who actually got hurt the most, coming to the party too late.
So I will, before we end, I want to see if you have some. So remember, the podcast is called Trends with Benefits. That's the name. So it's supposed to be talking about, to benefit the students to listen from these trends. So I'm just going to ask you, because you're our host, our guest today. Do you have any parting thoughts? Just some wisdom from Dr. Majeed Simaan.
Yeah, when the professor talks in the class, make sure to take notes than typing stuff in the laptop. I think again, there's no end for learning, right? I mean, some senior guy, mentor of mine, told me once, when he comes to the class, he likes to cook. I mean, as a metaphor, and he tries to put the best food in the table. And I think a lot of professors actually try to do that. Try to do the best they can. As a professor, also you expect that the students actually appreciate food, but your love and giving is unconditional. But again, this actually, speaking about how complex society is and humans are, right? So it's actually a dynamic game. I think it's a matter of, again, the professor at least try to do the best they can. But again, there's an endless ways, actually can, hopefully, at least from my teaching philosophies, I give you the best, structure, basics, and then the mindset, but it's also like the process never ends, right? So there's no right thing in doing stuff. And I think that's, at least in my teaching philosophy, I try to show the student is not really do it in one way. We can do mathematical, we can do numerical, and we have a lot of flexibility for addressing these aspects. And again, thinking is also part of solving problems. And I think we always challenge ourselves. Me, as actually, I did my undergrad master's in statistics, and it took me a while, to move to kind of like connect more dots, and we had a director who was a fantastic mentor, but he was giving me a hard time all the time, right? So especially as a PhD training, why are you doing this? Why are you doing that? So I think these are always important questions, think about stuff you're doing. And if sometimes you feel stuck, think about it again. If you feel stuck, think about it again. And if you're still stuck, take a walk, think about it, and come back. So there's a lot of thinking, and sometimes, things will would evolve over time, So, but keep up the good work. And there's an endless process always in terms of learning and improving. And of course, don't get too much to your comfort zone, right? So if you get to your comfort zone too much, you're actually not improving. So, and that's all I tell my students. Sometimes I'm like, oh, we don't know this. It's like, if you knew this, you wouldn't be taking my class. So I think that's part of the learning process, right? What's the point of taking a class you already know?
So as we come to the end of the podcast, I would like to thank you for spending your valuable time sharing your insights and knowledge with us. And again, like I said, I would really look forward to watching the docuseries that you mentioned. And you guys can know more about Professor Majeed Simaan also in one of his podcasts on FSC Stevens Spotlight on Faculty. As of now, thank you all for joining.
Thank you.